All right, let's dive into Merck's second quarter earnings for 2025. And what we've got here is a real head-scratcher, a classic Wall Street paradox. You see, the company posted some really solid profits, but the market's reaction, well, it was a brutal sell-off. So we're going to break down exactly why that happened.
So think about it. The company beats what analysts were expecting on profit, yet the stock takes one of its worst tumbles of the year. What on earth did investors see that made them hit the sell button so hard? That is the puzzle we're going to solve today. Okay, so first up, let's just look at the raw headline numbers that really set the stage for this whole thing. We've got a beat, we've got a miss, and we've got a pretty big drop. So here's that split personality in the results that got everyone so confused. On the one hand, earnings per share came in hot at $2.13. That's a solid 6% beat versus expectations. That's the good news. But on the other hand, you've got revenue, which actually missed what people were looking for. It came in at $15.8 billion, which is down 2% from last year. This just created a really murky picture that investors, in the end, decided was a bad sign.
And the market's verdict? It was swift and it was harsh. An 8% plunge on July 29th. Now, this was not just some small dip. We're talking more than double the average trading volume. We saw a huge spike in options trading, with people betting on the stock to fall even further. The market wasn't just worried. It was putting its money where its mouth was.
So you have to ask, where did all this pessimism come from? Well, to get the answer, you've got to pop the hood and look at the performance of Merck's two biggest blockbuster drugs, because they had wildly different stories this quarter.
And here it is. I mean, what a contrast. You've got Keytruda, the cancer drug that's just an absolute crown jewel for them, continuing its incredible run with 9% sales growth. Fantastic. But then look at Gardasil. Sales for the HPV vaccine just collapsed by a jaw-dropping 55%. And this was almost entirely because of an extended shipping pause in China, which really confirmed for investors that the vaccine market over in Asia is way tougher than a lot of people were hoping.
Now, of course, on the earnings call, management tried to do some damage control. They were quick to point out that Gardasil sales in China make up less than 1% of the whole company's revenue, and that they're not really banking on it for future growth anyway. It was a very clear signal to Wall Street saying, hey, look elsewhere, this isn't our future. So, if Gardasil isn't the future, then what is? This is probably the most important part of the story, because this quarter really signaled a huge strategic pivot from management. They're focusing on two things: cutting costs aggressively and buying new companies.
First up, the cost cuts. Management rolled out this brand new program with a massive goal to slash $3 billion in annual expenses by 2027. Now, this isn't just about pinching pennies. It's about freeing up a ton of cash so they can go out and acquire new, faster-growing drugs and technologies.
And you can see exactly where that capital is going. Management is trying to build what they're calling replacement power. Basically, finding the next big thing to drive growth after Keytruda. They're jumping into totally new areas, buying companies like Verona for its COPD drug and SpringWorks for oncology. At the same time, they're pushing their own pipeline forward, getting their new RSV vaccine approved and seeing really positive data for a heart disease program.
Look, all of this, the cuts, the M&A activity, it's all aimed at solving the single biggest challenge hanging over Merck. It's the elephant in the room, solving the post-Keytruda growth puzzle.
You see, everything we're talking about really comes down to this one acronym, LOE, which stands for Loss of Exclusivity. For anyone who doesn't follow pharma closely, this is the moment a drug's patent expires. When that happens, cheap generic versions flood the market and sales for the original drug absolutely crater. And this timeline, well, it really lays out why investors are so antsy. Sure, another drug, Mavenclad, loses its patent in 2026. But the main event, the one everyone is laser focused on, is 2028. That's when Keytruda, Merck's multi-billion-dollar growth engine, goes off patent in the US. The market is looking at every single move Merck makes today through one lens. Can they fill that massive revenue hole in time?
So, let's put it all together. What's our take on Merck as we head into the next quarter? Here's our thesis.
Okay, here's our call. We predict that the pressure we're seeing on the drugs that aren't Keytruda is probably going to continue, especially with Gardasil's issues. For the stock itself, we expect it to be pretty much stuck in a range with some downward pressure until one of these new drugs they've acquired really proves it can scale up. For those reasons, we're rating the stock market perform. Right now, Merck is just caught between the incredible ongoing strength of Keytruda and this deep, deep uncertainty about what comes next.
So as we head into the second half of the year, here's what we're keeping a close eye on. These are the key checkpoints. First, that Verona Pharma deal absolutely has to close in Q4. We're going to be looking for any sign that Gardasil demand is stabilizing. The initial sales numbers for their new RSV vaccine, Enflonsia, are going to be critical during the fall season. And finally, you always have to watch for policy headlines out of Washington around drug pricing. The market needs answers, and how Merck handles these points will really determine if they can solve this post-Keytruda puzzle.
And as always, a final reminder. This analysis is for informational purposes only. It is not financial advice.